Hey, it's Craig back with another Mortgage Minute. And I got asked a question by a first time homebuyer the other day that was a very simple question, but a really, really good question. I thought, you know what? We need to do a quick video about this. So, the question I got asked is, hey, I'd like to buy a home, but what all is included in a mortgage payment? And I thought, man, what a really, really good question. So, to think about a mortgage payment, there's really three main components, and then there's a fourth component that may or may not be applicable. And for a lot of first-time home buyers, the fourth component is applicable, so we'll talk about that. So the three main components of a mortgage payment is the principal and interest portion of the payment, the taxes, and the insurance. Okay. And then, like I said, we'll talk about the fourth component in a second. So, the principal and interest portion of the payment, I want you to think of that. The best way I can think to describe it that would probably make the most sense is kind of like a car loan. Okay, so if you go to buy a car and you finance that car over I don't know, a 5 year or 6 year time period, you're going to have a car payment associated, with that loan. And basically, what that is that's whatever you're borrowing, and then whatever the interest rate is, and then the payment is determined by the amortization schedule to get that car loan paid off during that time period. Well, a mortgage is no different. A mortgage is amortized in a lot of cases over a 30-year period. Okay, so you've got a principal and interest portion of your monthly payment that at the end of that 30-year period, that loan would then be paid in full. Now, hang with me for a second, because I know 30 years seems like a long time. Honestly, on average, most loans stay on the books for about 5 years. And there's lots of reasons for that. One of the main ones being if somebody's a first-time home buyer, they're probably not going to keep their home for 30 years, okay? But just as an example, if it were a $250,000 sales price and someone were putting no money down, okay, the principal and interest portion of their payment would be somewhere around, let's just call it 1530, okay? And so that's basically no money down, and then the principal and interest payment, $1,530. But that's not the only part of the story, okay? Because you also have to provide insurance on the property that you own. So let's say homeowners insurance costs $1,200 a year. The way it works with your mortgage payment is if the insurance premium is $1,200 a year, you just take 1/12 of that, and then that is paid as part of the mortgage payment. So 1/12 of $1,200 is $100. So then that gets included in the mortgage payment. And then you've also got property taxes. So let's say on this $250,000 house, the taxes are $1,500 a year. That's $125 a month. So each month, $125 is included as a part of your mortgage payment. And then at the end of the year, the lender will pay those property taxes for you. Okay. So you've got your principal and interest, you've got your insurance, and then you've got your property taxes. You've got your homeowner's insurance. Now, the fourth component that for a lot of first-time home buyers is applicable is something called mortgage insurance. And what mortgage insurance is, that's an insurance premium that protects the lender if you put less than 20% down on your home purchase. And the thought process being, if you put 20% down and for some reason you can't make your payments, the lender is going to basically foreclose on the house and resell the house. And if you had put 20% down, there should be enough of a cushion that the lender is not at a huge risk of losing money on that transaction. So if you put less than 20% down, that insurance premium gets paid. So if in the event that you can't make your mortgage payments, and if the lender has to foreclose, and if they resell the property and there's a loss of some sort, that insurance company would then step in and reimburse the lender for that loss. Okay. So 4 components: principal and interest, homeowners insurance, property taxes, and if applicable, mortgage insurance. So let's talk about real numbers. For a $250,000 house, putting no money down, you would be looking at a total estimated payment of $1,876. Now, I'm just kind of giving you an idea of what a monthly payment like that would look. And so as you're listening to that, you might be saying to yourself, yeah, but you know what? My rent's only $1,700 a month. So $1,876, that's $176 more per month. Why would I do that? Well, let me ask you this. At the end of 5 years, when you go to make your final rent payment, is your landlord going to write you a check for all of that equity that you've built for your landlord over the previous 5 years? I think we all know the answer to that. They're not going to. Okay. But if you own a home and then 5 years down the road, you go to sell that house is most likely going to be worth more than what you paid for it. And during that 5 year period, your principal and interest payment has been paying down your mortgage. So now the amount that you owe on that house is less than when you started. The difference when you sell the property is what's called your equity. That's money in your pocket. And that's how you build wealth. You don't do that when you rent. So if you've got questions, if you want to take a look at your options, give me a call, 615-498-5626. And I appreciate you watching.